The government here is awash with cash, at least in the short term. So what does that mean for the choices it now makes? Deloitte Access Economics is one of Australia's most highly regarded economic forecasters. And earlier this week, I spoke with Stephen Smith, its chief economist.
There's been an astonishing turnaround in the budget balance from the lows during the pandemic. But the budget's in a very odd position. On the one hand, there are some challenges. On the other hand, it's the envy of most governments around the world. And we think that means it's a bit of a tricky balancing act for the Treasurer on budget night.
OK, you talk about a tricky balancing act because he's talking tough, warning people of tough times coming and warning that really sort of the money that's coming through the door right now can't be guaranteed, which is true. But the fact of the matter is he's in rude health as compared with where he otherwise thought he might have been before the election.
Well, we think he's going to be announcing some big increases in revenue. That's true. About 114 billion worth over the next 4 years, about 80 billion or so thanks to additional company tax receipts. That's due to higher commodity prices, of course. But he'll also be talking about higher spending. Spending also expected to be revised upwards in this budget, and so a structural budget deficit which requires more attention.
OK, so we're just having a look here at the underlying cash balance to GDP, which shows that at its worst during the pandemic, it got down to minus 6%, now to minus 2%. Now, sure, the government is still losing money technically, adding to the debt, the $1 trillion debt that he keeps on talking about. But as I point out, they're now much closer to getting back to a balanced budget than what ever could have been imagined.
That's absolutely right. As I said, the budget balance has improved dramatically from the depths during the pandemic. But in a lot of ways, that's the easy part. The heavy lifting is still to come. So we've been through this period, particularly in the last 12 months, where three things in particular have gone well for the budget. The first is very high commodity prices. The second is very low unemployment. And the third is high inflation. I don't think we'll hear the Treasurer speaking on budget night about inflation being good for the budget, but it absolutely is. The amount of money being spent around the Australian economy is higher. Taxes are a share of spending in one sense. And so, those three things are really helping the bottom line at the moment. But they won't continue to help the bottom line. And so it's a hard grind back to a balanced budget from here.
OK, so then a lot of talk has been about the stage 3 tax cuts. The government has committed to those. But do we know that the government also collects more than half of its revenue from PAYG taxpayers? So the more people that they can get to stay in work, though it might be inflationary on one hand, it also helps them in terms of their long-term stable revenue.
That's right. The stage 3 tax cuts have been a big point of discussion over the last few weeks, as it looked like the Treasurer and the Prime Minister might be wobbling a little on an election commitment. We think that's missing the point somewhat. It shouldn't be a will they, won't they guessing game on election commitments, but there are important policy points to discuss here. You're absolutely right. Taxes on individuals raises close to half of all tax revenue for the federal government. Even with the stage 3 tax cuts in place, that will continue to rise. Without the stage 3 tax cuts going ahead, that share of federal tax revenue coming from taxes on individuals would get close to 52% in 25-26. That would be the highest level since before the GST was introduced in 2000. The budget definitely needs more revenue. But we don't think necessarily that individuals is where that should come from. Australia relies a lot on taxes on individuals and companies, and some broader measures across the budget should also help to do the heavy lifting.
And this is where we find out whether Jim Chalmers is the true reformer that he's wanted to paint himself as being, or whether he's a meat and potatoes treasurer who simply tries to either balance the budget, but the true reform is trying to change the tax mix away from individuals and to other forms, consumption taxes, to company taxes, these types of taxes which genuinely do, if you like, amount to real tax reform.
That's exactly right. We would be in favour of a change in the tax mix, which saw a slightly higher GST. which saw and some of that revenue flowing to the federal government, which saw taxing the very high profits of the Australian resources companies at a greater level than we currently do. We also think that there are very large tax expenditures in the budget. So the generous tax concessions, for example, that we provide property investors and people for their superannuation contributions and earnings, where there are that's costing billions of dollars to the federal budget, and so those things need to be looked at in terms of reform and this Treasurer. We're still in pretty early days for this government. There's quite a long way to go until the next election. And these things aren't easy. That's why they haven't been touched for a long period of time. So, we're hopeful, and we think it's necessary.
Now, Stephen, we just put up a chart there just a short time ago showing the actual increase in the company tax, the rolling 12 months. We've got it on here now, showing really that the rise of company tax out to June 22 up above $120 billion. Now, that's the windfall in many ways because of the resources boom, but also many companies have done really very well. The problem is if the country goes into recession because interest rates go too high, that company tax comes into jeopardy. That can't be guaranteed that the government will keep that tax year in, year out.
That's absolutely right. That is a cyclical benefit that the budget's receiving at the moment. The structural budget deficit, that is, after you take out the impact from lower than average unemployment, higher than average commodity prices, that's where the hard grind back to a budget surplus really sits. I should say as well, a recession is not our base case in Australia, although we do see the UK and Europe likely already in recession and the US headed that way as well. But Australia at this point we think will avoid a recession. The big risk that we see is that inflation hangs around a little bit longer than what we expect and what the RBA is hoping as well. And as you say, pushes interest rates higher. That has the potential to tip Australia into a downturn, and would certainly have an effect on the budget.
And this is why in this budget it's very important that the Treasurer, the government, don't spend money that they might presume is coming into the future, which might be money that disappears, i.e. company tax, resources, royalties, all that type of money, which can be, if you like, can come and go as compared with the money that they know, the underlying, money that's coming that you talk about. That's the key right now.
That's absolutely right, and I have to say, I think that the comments and the broader commentary from the Treasurer and the government have been along those lines to date as well. It remains to see on budget night, though. We're expecting some pruning of some wasteful spending, perhaps, and some modest changes. We're not expecting big policy announcements in this budget on the 25th of October. Rather, the government buying itself a little bit more time for some bigger announcements post October and prior to the May budget.
Stephen Smith, partner with Deloitte Access Economics. Good to chat to you today. Many thanks for your time.
Thanks, Ross.